new lows, but I think on balance, like 60% probability that the lows are in of growth tech and the lows are in of crypto.
Hey guys, welcome to the Daily Crypto. Inflation remains at the height of the 80s and prices of essential commodities are still scary. Is inflation going to remain this high? How does that affect the crypto market? Should we expect new lows? Keep watching to find out as we answer these questions with Raoul Pal. Diving right into the heart of the matter, we ask, when do we start making sense of all that is happening in the world of finance from the macro landscape? Raoul Pal answers.
So what I try and do is step back from all the narratives, right? It's a very narrative-driven world these days, and everybody's pushing a different narrative based on their own perspectives, which is fine because these are all probabilistic outcomes and stuff we can't know until things have happened. So I try and step back and apply my business cycle framework and my secular framework to what's going on right now. So the secular framework remains to me that debt, demographics, globalization, and technology are deflationary over time. Doesn't mean we can't have cyclical inflation. Now, the question the market's struggling with right now is this a change in the inflation backdrop? i.e., is the rate of change of prices going to continue? Doesn't mean the prices stay the same. People get confused with this. They think, well, if oil's at $100, that's inflationary. No, it's only inflation if it goes back to $200. It has to keep going up. So the question is do we have those conditions in place with all that we know? So what is the predominant driver of inflation? The predominant driver of inflation has been, in my view, the restricted supply of both commodities and other goods and services because of COVID. And that's still working its way through the system, so we can't know yet.
He adds that on a probabilistic framework, he would defer to his long-term secular framework of deflation. In that case, what drives inflation up and down in the business cycle?
That is the tightness or looseness of monetary conditions. Now, everybody's focused on the Fed right now. What are the Fed going to do? Now, the bond market priced this in ages ago. So the bond market's already said, 2-year rates are, kind of 3% and 10-year rates are about 3%. The yield curve's been inverted, saying we've got a recession coming. So monetary conditions are going to get too tight. But when I put together a bunch of indicators about what real monetary conditions are, because it's not just interest rates, you've got to think about the rise in the dollar as also monetary conditions. So the higher the dollar goes, the tighter financial conditions are globally because there's less dollars around. And additionally, the rise in commodity prices takes purchasing power away from both companies and individuals. So when you add those three together, the year-on-year rate of change is pretty close to being unprecedented. And it prices the ISM, the Institute of Supply Management Survey, which is the best guide to the business cycle because it's monthly data as opposed to GDP, which is quarterly and gets kind of readjusted later, suggests that the ISM is going to fall from where we are now, 50-something, to something like 35. Now, 35 implies like a negative 3% GDP. So it's a decent sharp recession because of what's happened. It's kind of baked into the cake, and we're starting to see economic indicators.
Inflation is a lagging indicator and employment is the other. On inflation itself, Raoul indicates that all the commodity prices have come off their highs. Therefore, if the ISM goes lower down to 45, which it most certainly would, that would suggest that we are in a recession already, and inflation over time follows this.
For that, I think bond yields have topped, but I need to see those conditions in place, and I think it's only when people start realizing that growth is going to fall. So I think we're in recession. I think it's going to be sharp and pretty nasty, a little bit like 1974. The situation, the current macro backdrop, actually reminds me a lot of 1947.
There are lots of indicators suggesting some of this stuff is getting overdone. Not probably completed yet, as there is probably another down leg, but also that economic trough probably gets reached sometime around March of next year before we start recovering. So how does this affect the crypto market? Raoul Pal explains.
Also, crypto markets, well, The macro driver of crypto is two things. One is the central bank balance sheets. If they're expanding, crypto is generally doing well. Now, currently they're contracting, but we're starting to see signs of changes. It's still early days yet, but I expect the central banks to stop trying to tighten their balance sheets and eventually move to loosening as the recession becomes more apparent and the inflation fears recede. The other macro factor that drives crypto is the money supply growth, global M2. Global M2 has been shrinking, and that has taken away the steam from the crypto markets, and it follows it broadly. It's not a perfect fit, but it's a pretty good fit. So basically, you need to see money supply growing. Now, what's good is we've got forward-looking indicators to tell us about money supply, and it's actually the inverse of ISM. So what it's telling us is going forward, the probability is the money supply globally starts increasing, and we're already seeing the signs of that in China, where Chinese M2 is coming up, and I think we'll see it elsewhere as, for example, the European banks start to struggle a bit, and so money supply starts increasing. So I think we're at the macro inflection point. I think bond yields fall over the next, we'll look back in 2 months' time and bond yields will have, broken 275, which is the floor, I think, in 10 years, and be heading down to 2%.
Generally speaking, Raoul adds that we are at the end of the cusp of return, and that is probably what the crypto markets are picking up. He points out there is still a probability of new lows.
But I think on balance, like 60% probability that the lows are in of growth tech and the lows are in of crypto. Of the rest of the markets, like the S&P, I don't think so. I think we've probably got another leg lower to come, but crypto and tech will outperform. So that's my view.
In that case, is the year-on-year rate of change going up, or do prices just remain high?
Now, the year-on-year change going up is what generates inflation. I'm not sure we can really generate significant inflation. So my base case is actually inflation goes negative in 18 months and then recovers somewhat back to a normal cycle level. What that means, I don't know, whether that's 3% or 4%, at peak inflation at the top of the cycle, at the top of the business cycle, possibly. But there is a risk, to my view, that maybe I'm wrong and inflation comes down from 9% where it is today, gets down to 6%, stabilizes here, and then 6% inflation is persistent, and that's a pretty ugly world. I get the arguments. I just think it's difficult to do. And I also think that, generally speaking, if you look at things like, Elon Musk building car factories in the US and Germany, what he's doing is using robots. So as you move the manufacturing back, you're replacing people with robots, which is deflationary. And we can see that in most places. So the robots are taking over the world along with artificial intelligence, and there's pretty much nothing we can do about it, because as technology improves, the cost of that technology collapses, and basically everything that's digitized goes to zero in cost over time.
These are the brutal facts. Raoul Pal mentions another structural element, the ESG. This is the forcing of adherence to ESG mandates and investments by the European investment community.
Demand-led inflation in the 2000s, from like 2000 to 2008, driven by China. So as China came onto the world stage, it consumed enormous amounts of resources. There was a massive demand shock for the world. Commodity prices exploded, but inflation averaged 2.5%, 3%. So it's not clear that inflation is the big thing. You can be a commodity bull, and I think coming out of this, you can probably be a commodity bull and a technology bull at the same time. I don't think it's an either-or situation, but I don't think that prices rise and stay high at a rate of change long enough to create persistent long-term inflation.
Raoul indicates that if you got some supernormal profits being driven by structural problems like the supply chains, it is a race to solve them, because it is in the best interest of the company to capture the supernormal profit. He also adds that supply chains changing may be more efficient in the end.
Along the way, and if you've got less friction points along the way, sure, the overall level of prices may remain slightly higher because it's slightly costlier to use, let's say, European labor than US labor, or North African labor versus Chinese labor, or whatever it is. Yes, they can remain higher, but again, it's not high commodity prices that cause inflation, it's the rate of change.
Raoul points out that this is one of the most uncertain, complex macro environments that any of us have ever lived through. So there are a lot of probabilistic outcomes, like the crypto liquidation event, for example. The Fed's monetary tightening has now washed through the crypto markets and is now less prevalent, so to say. It is important to note that Raoul Pal used to be a Bitcoiner. Then he became a Bitcoiner with a bit of Ethereum. Then he became an ETH holder with some Bitcoin, before he finally disavowed Bitcoin altogether. What catalyzed Raoul's directional move over to altcoins instead of how he started?
So it's nothing about the philosophy of Bitcoin that people like to think that I've changed my mind on. It's nothing about what I think the future of Bitcoin is, which I haven't changed my mind on. You know, I wrote the first macro strategy piece on Bitcoin, I think ever published back in 2012, 13, and I've maintained that view. But my job as an investor is not to have my philosophy rule my investments. Some people can, and that's okay. I have no issue with it. But what I started to do was understand, okay, what drives the price of Bitcoin and what drives the price of digital assets overall? And that's when I started digging into Metcalfe's law and network adoption models. And I realized, okay, now I've got a pricing framework for this stuff. So then I started doing the work and I saw that the ETH network was growing faster. And it's basically about volume, dollar volume transacted on, let's say, a monthly basis versus the number of active addresses. And ETH has been outperforming for a significant period of time in terms of the vibrancy of its network. And I looked at the chart of the cross rate of ETH versus Bitcoin. It looked like it was going to break out. So I started dipping my toes in. As soon as it broke, the ETH chart itself looked great. So I started thinking, well, if I want to get allocation, I believe in Bitcoin, I believe in blockchain, I believe that Bitcoin has a massive role in the future of the global monetary system.
Raoul reveals that he thinks ETH will outperform Bitcoin, but his philosophy on Bitcoin as a revolutionary technology has not changed.
And, you know, I maintain that view. So my view maintains that I will adapt if I see opportunities for creating excess profit. So things like NFTs, they become interesting because they're actually call options on ETH. Because over time, if the ETH ecosystem does well, more money piles into NFTs. NFTs outperform ETH itself. And so therefore, you've got the basis of ETH going up.
Raoul points out that ETH will provide risk-free yield because the staking will give you the yield, and that staking is mechanically part of the construct of the smart contract. So it all depends on whether you want to own the underlying currency or not. Thank you for watching this video. What do you think of yield staking? Has Raoul influenced your position on yield staking? Let us know what you think in the comments section below. Don't forget to smash that like button, share our video with your friends and family, and subscribe to our YouTube channel for more amazing content. See you on the next one. Until then, bye.